Hello and welcome everyone. We're just going to wait just a few seconds while folks join the webinar. We really wanted to welcome you and thank you for joining us tonight to help learn and get educated. And I am really excited to share more information about budgets and budget disclosures and really kind of unravel the mystery that comes with this big package that everybody receives at some point during the year, depending on when your fiscal year ends. So we'll just wait another minute or two and let people join. We still have a few people who are entering the webinar, but please bear with us while we let folks join, and we will get started in just a minute. All right, we'll wait till 6:32 and then Shauna, you can start.
Great.
All right, and there we are.
Okay, let me share my screen. Welcome everybody to our first homeowner webinar. This is open to all of our residents. We're really excited to have you here. I get the pleasure of introducing our speakers for today's session. We have Netta Neharai, who is the CEO and founder of HOA Organizers. We are a fully accredited community association management company. Netta is the past president for her local Community Associations Institute chapter. She's coordinated, hosted, and talked at numerous educational sessions and is an active speaker for various CAI events and strategic planning sessions, both locally and nationally. Netta has attributed her success within her company and in CAI to her strong leadership skills, identifying her keen ability to recognize the strengths within her teams and direct those strengths to what people do best. I will say in her free time, she enjoys playing the piano, reading, sports, running and exercise, cooking, and recently took up golfing. And then we have Derek Barrow, our financial controller. Derek joined HOA Organizers in 2022 as our financial controller. He brings a robust background in financial management and operational leadership. He's a graduate of UC Santa Barbara with a degree in business economics, and he's quickly established himself in the property management industry, working as a controller for a large multinational residential property management company before joining our team. He has extensive experience in managing complex financial systems, and coupled with his strategic mindset, it makes him a great asset for our organization. And with that, I'm going to send it over to our speakers.
Thank you, Shauna. I appreciate that. Thank you so much for the introductions. So just before we start, I wanted to cover a couple of housekeeping issues. So there at the bottom of your screen, you will notice that there is a button that says Q&A. So if you have any questions throughout this webinar, please feel free to click that button and type in the questions that you have. Matt has joined us. Matt is our COO, and he's here so that he can help field questions. We're going to save the Q&A until the end, and we may not be able to get to all of the Q&As publicly, but Matt will be doing his very best to respond to the questions that you have. So feel free to put them in. He is also a PCAM and very well qualified and capable to answer any questions you have about the budgets, and will do his best to answer any questions. All right, let's kick this off. So what we wanted to do today or tonight is really talk to you about your budget packages. Many associations, most, are operating on a calendar fiscal year, which basically means that you as an association, each association is a business, and every business for tax purposes is required to identify your year, your financial year. And most associations operate from January 1st to December 31st. I'd probably say there's about a 20% exception with our clients. So the Civil Code requires each association to compile this package and send this out to all homeowners in the associations no less than 30 days and no more than 60 days in advance of your financial or fiscal year end. The only time that changes is if your governing documents specifically say something else, but the civil code here is cited if you wanted to look up anything related to the budgets or budget packages, you're welcome to look up Civil Code 5300. So we figured many of you would have just received this package about a month and a half ago and may have received something that feels like a monstrous package, right? It's 50 pages. You have no idea what this means. And we really wanted to go through and explain what each component in this package is and really just tell you what to look for and how to navigate this package. I myself live in an association and I feel that I am at an advantage because I know what to look for because this is what I do for a living. But most people see this package, they'll look at the front cover, they'll just look at whether or not there's a dues increase. And that's the main thing that they focus on. And then they sort of put it aside. So we'll be able to explain how to navigate this pretty quickly and what to look for. And Derek is going to help me with the specifics. So let's move on to the next slide. So let's start with the budget process. When you receive this package, you may think that it's just, kind of magically put together, and I wish that were the case. But we actually start this process 9 months roughly ahead of when you get the packet. So one of the legal requirements of an association is to conduct a reserve study. And I'm also going to briefly touch on what a reserve study is because I'm using some words that, depending on how involved or what you know or what you don't know, we want to make sure that we cover and explain from the basics to the more specifics. So a reserve study is a study that is conducted by a third-party company. They come out and they take a look at your property and they identify all of the components that may need to be replaced. So for example, for a condominium complex, they're going to list things like your elevators. They're going to list things like your roofs. They're going to list things like painting the exterior of the building. Anything that needs to be replaced is going to be listed on this reserve study. And California requires us to do this, to have this report updated every year, but once every 3 years, a company or somebody has to come out and physically inspect the property. And the reason for that physical inspection is to take a look and make sure that a component didn't deteriorate in a more accelerated fashion than what they have identified. So the reserve study looks at the components, creates this component list. It tells us how much it costs on average to replace that component and how much time is left to replace that component. And then once they get this long list together, then they figure out how much you should be saving, how much you need to have in your savings in order to replace these items when the reserve study says you should replace it. And then, for example, if your reserve study says you should have $1 million this year to be on track, but you only have $500,000, they're going to tell you that you have 50% funding. So we use that because as part of the budget process, the reserve study company, as part of their report, will tell us in order to be on track, you are going to need to save this much money. And here's the plan. You should be saving to catch up so that you can have the $1 million that you're supposed to have. You need to be saving, let's say, $10,000 a month. So we have to back that number in to the draft budget and follow the reserve study's recommendation, or try to recommend that the association follows that recommendation so that we are appropriately planning and saving. So we start the reserve study process. I just explained that somebody needs to come out once every 3 years. They need to inspect the property. Then they need to update this report. So they take about 2 months to do that from start to finish. So we get our bids, we give the bids for the reserve study update to the board. The board approves it. Then we as management have to participate in filling out a questionnaire and providing some financial information and updates to the reserve study company. Then we get the draft reserve study back. Once we get that draft back, we see what they recommend for a reserve contribution. We start drafting the budget based on last year's actuals. We also start contacting vendors and insurance carriers to figure out if there's any planned increases for the next year. And then we prepare this draft budget. Our process is that the draft budget goes to Derek, who's our controller, so that he, looks at things from a high level financial perspective. It comes back to the manager, and then the manager submits the first draft to the board. So believe it or not, all of this started in March. And by the time we get this over to the board, it's about October. We do August, September budget draft. And then we give the board a deadline of 2 months, so about October 10th, to approve the budget. Once the board approves the budget, then we have to go back to the reserve study company. We have to give them the budget. We have disclosures to fill out, and we have a bunch of additional paperwork to assemble and put together. And then you as homeowners will receive your package somewhere between November 1st and December 1st, generally speaking. So if we go to that's the process. If we go to the next slide, we'll start talking about what you can find in the actual package. So Shauna, hit the next slide for me, please. Thank you. So on the cover page, if you get one of our disclosures, on the cover page, you're going to see kind of like a table of contents. And it lists out, first of all, at the top, you will see, there we go, thank you. So you'll see at the top that whether there will be a dues increase or not, so we just kind of put together a mock cover page for you as an example. And, if there's a special assessment, if there's a dues increase, it'll be right here at the top. And then you'll also find these following items that we list out for review. So we have the budget, we have the fee schedule, which means it's a breakdown per unit, especially if there's like variable assessments. This is typical in condominium complexes. We have the insurance disclosure. We have a unit interior insurance advisory, the association's funding disclosures, major component repair statement, and so on and so forth. So all of this, again, to most people will mean gibberish, but we're going to go through again and explain it. So go ahead and let's go into the budget package and scroll down into the budget. So the first thing here is that you'll see your budget. Derek's going to go through this in greater detail, but it's important to know this is probably the most critical thing to learn how to read and understand, because this talks about how your association makes money and what they have to spend money on. And a lot of times when people don't look at this and they don't understand why the board comes up with the number that they do for dues, it really boils down to this. So let's keep going. Most of these are fixed costs. Like your water is your water. And, unless there's a major conservation effort, which is tough, to really move the needle, that's what it is. Insurance is going to be your insurance for the most part. And then your regular contracted services are pretty typically going to remain in line. Even if you change a company, they're pretty competitive. So prices are going to be pretty, tight. But reading that is really important to understand. And then under reserve allocations, before you scroll, I mentioned that the reserve deposit allocation, that's an annual number that would have been on the reserve study, or should be on the reserve study, and mimic it. And we'll get to that in a moment. So we're going to take that number that they've given us and recommended that this association save, and plug that into the reserve or to your budget to get that number. So now we have the variable assessment. So based on the units, we specify what each unit is responsible for paying, so that there is no ambiguity there. Then we have the insurance notification. So as part of this package, it's a legal requirement to list out all of the types of insurance that the association carries, who the carrier is, what the policy term is, the dates, what the deductible is, and what the limits are. So this is the one place where you can see all of it. You can also request it anytime or find it online on your portal, but this is kind of one spot where you can know this is where all of that information is if you ever need it. If the association carries earthquake insurance, you'll see that they carry it or not. In this case, you'll see NA because the association does not have earthquake insurance for this association. Let's go to the next spot. So this is the interior coverage information. So this was a letter specifically that is put together by the association's insurance agent. And it really talks about what type of policy there is and how that affects the interior of the unit. So in this case, this association has a bare walls coverage, which basically means any upgrades and anything done in the unit is not covered by the association's policy. So homeowners are made aware that if they want to protect their interior and have coverage for it, that they will need to have a supplemental insurance to cover it. So this is an important one to know so that you can share this with your personal insurance agent and get guidance on what you will need to ensure that you're protected. Okay, let's go down to the next. This is the assessment and reserve funding disclosure. So I mentioned once the board approves the budget, we take that budget and we give it back to the reserve study company, and then they fill this out. So this is a disclosure to homeowners that tells us very clearly, this is how many units there are. This is the approximate, these are the assessments that are due and when they're due. It talks about whether or not the association has enough in their reserves. So keep going down. This is the reserve disclosure, the executive summary, this is the 30-year reserve plan. So this will tell us that this particular association, if you look in 2026, they're only 16% funded, which is not good. As you can see, the special assessment risk is really high. Generally speaking, if you see 30% or lower, the risk of a special assessment is quite high. So as an association and as homeowners in the association, you really want to work towards improving your reserve funding balance so that you don't get hit with emergency special assessments or large special assessments. You want to come up with a plan collaboratively to make sure that you have enough savings to deal with the replacement of components. What happens if you don't replace the components in a timely fashion? You basically start bleeding out money in a different way. So for example, when your reserve study says you really need new roofs, if you don't have the money for new roofs, what's going to end up happening is most homeowners are going to experience roof leaks. And then the association is going to have to pay for interior repairs and roof repairs and continue to kind of patch those the roof. But that's not helping the issue. We have frustrated homeowners, we have displaced homeowners, we have interior damage, potential mold claims. And so that just gets more and more expensive. So maybe you're kind of paying for it by the tune of a couple $1,000s here and there as these roof leaks come up. But replacing the roof just kind of resets that component and ensures that the building and the units are protected. Then we have the executive summary. So again, in this case, you'll see that there's an X marked off in the red, which means that the risk of special assessment is high. For this association, this year, a fully funded balance would have been over $3 million, but they only have $568,000. And that number, the fully funded reserve balance, is subject to change every year. It will never stay the same. Next year, that fully funded balance might actually be lower because the reserve study is going to tell them you should be spending about $1 million this year because you're going to be doing all these projects this year, or you should be. And so they're looking to reset some of these components by spending the money and getting some things done. So that number is going to fluctuate year after year. But the point is, the association really needs to have a plan to make sure that you have sufficient funds. And it's not even about the component list. What about an emergency? This association doesn't have earthquake insurance. What happens if there's an earthquake? What happens, if in an earthquake, there's some catastrophic events that require the association to use those reserve funds to secure the building. If they don't have the funds to do that, then they're going to have to do emergency special assessments. So let's keep going. This is the executive summary. So as you can see, the items in yellow here, these are the items that the reserve study specialist is saying based on our visual inspection and based on manufacturer's standards, these need to be replaced. So from the rec room refurbishing to mailboxes needing replacement, maybe those are aesthetic and maybe those can be pushed off. But when we talk about replacing the metal fences or repainting the metal fences, painting protects and preserves the metal. So we don't want to start seeing deterioration by having the metal rust. When you paint it, you're coating that component. So if you fail to coat that component with painting, you're going to actually spend more because you're going to see chunks of that metal missing over time because it just kind of rusts through. So there are certain components that, again, are just not just aesthetic, but actually are required to protect the building structure and integrity. Okay, let's keep going past this. We'll keep going. Okay, this is one of the newer things that the statute requires, which is the major component repair statement. For all of those items that were highlighted in yellow that the association's reserve study calls to be replaced this year, this is a new disclosure requirement that says, okay, is the association planning on replacing this year or not? So now we have to tell our homeowners if this is going to be done. As you can see, this association has no's and undecideds all across. So this association is not really kind of approaching things with the best industry practice because they're deferring a lot, which basically means there's going to be more damage and it's going to be harder to kind of get out of this hole. So let's keep going. This is, and then there's all these other things that these little disclosures that the statute requires. So this is the disclosure of whether or not an association has a loan. We're required to disclose this every year. Keep going. This is a disclosure of assessments and foreclosures. So what happens, this is part of the civil code, and it's in part in your CC&Rs as well. So if a homeowner does not pay their dues, what happens? This is a disclosure that, the statute has picked out as, this is important, even though it's in the CC&Rs among 200 other things. We want to extrapolate this specifically and make sure that homeowners have this in their package so that they know if they don't pay, here's what happens. And this is the process and this is the timeline. So that's included in here. And it tells you where you can submit payments, a physical location to submit payments, and what you can do for payment plans. Then there's the collection policy of the association, which again mimics your CC&Rs. Your CC&Rs will specify what the repercussions are if a homeowner does not pay their dues on time. But again, this is one that the statute just picked out and said, we want homeowners to make sure this is highlighted. So as a legal requirement, we want the collection policy not just to be in the CC&Rs that homeowners hold in their possession. We also want homeowners to see it in this package once a year. So keep going. And we'll explain couple more disclosures. They also want you to know whether the association is FHA approved or not. This is just a FHA approval is a lending parameter. If an association has FHA approval, that means that they've gone through and applied with the FHA and gotten approval so that a specific type of lending is available to any potential or prospective buyers. Most associations, at least that we work with, are not FHA approved, but but this will be the disclosure. We'll keep going. And then the same thing with the VA certification status. I don't think we manage any associations, I could be wrong, that are certified by the Federal Department of Veterans Affairs. So it's just another disclosure that we're required to include. And then this is another process or another disclosure that is spelled out in civil code, but the package will include, what do you do if you are in dispute with your association? If you're in dispute, this is an outline of how you can approach the board outside of the initial request for a hearing. You can request internal dispute resolution or alternative dispute resolution. And again, this spells that out. So this is good to know. If you have a dispute, you can look at this document that's in your package. We'll keep going. Keep going. This is all part of the IDR and ADR. And then there's notices regarding discriminatory restrictions. Basically, just to notice that the document does not contain any information to restrict based on the standard discriminatory categories. There's a notice of safety and security where we, talk about the fact that the association is not responsible for crime or theft, standard notices. And then homeowners have a right to submit a secondary address to the association. So this is required to be disclosed. If you have a second address and you want mail to be delivered to 2 locations, we're required to tell you that that's possible. And there's a couple more pieces like that. So as we get kind of further down, there's also one other thing that's important here that you should also receive a copy of is your architectural guidelines. We include that. There's a copy of your rules and regulations as well. But for me personally, when I look through these documents, I know that they're there, and unless I need to access them because I actually want to engage in one of those processes, I personally would not necessarily focus my time, attention in reading that. Most of the time, it's going to be the same. The last 35 pages are going to be the same year after year because they're either based on civil code or they're based on your governing documents. And so it's going to be reiterating the same thing. I would focus on your budget, your reserve, study, and Derek's going to dive into that further. So I'm going to turn it over to you, Derek.
Thank you, Netta, and hello, everyone. I'm going to be discussing the 2 most important documents in your annual disclosures, in my opinion, which are the budget and the reserve study. The budget is your HOA's financial game plan for the upcoming year. It shows the total expected income, so your dues or other income, the total planned operating expenses, things like landscaping, insurance, repairs and maintenance, utilities, and finally, it shows how much is being set aside to fund reserves. The reserve study tells you what large projects are coming in the future and whether your HOA is financially prepared for them. The reserve study, as Netta said, is an independent report created by a reserve study analyst. It is a 30-year financial forecast for major repairs and replacement of your common area components. So things that the HOA is responsible for. Things like roofs, plumbing, elevators, pools, asphalt, etc. It also it identifies the remaining useful life and estimated replacement cost for each component. It also tells you your HOA's current reserve funding percentage, the strength of that funding percentage, as well as the recommended funding plan for the current year, and if there is a special assessment recommendation. Together, these two documents directly impact your dues, the likelihood of a special assessment, your property values, and the long-term financial stability of your HOA. If you understand nothing else in your annual disclosures, understanding these two documents alone puts you far ahead of most homeowners. When you open your budget and your reserve study, it can feel overwhelming. You don't need to be an accountant. You just need to know what to look for. So here are the 10 most important things to look for. First, always look for dues increases and special assessments. This will be listed for you on the cover page of your annual disclosure. Sean will pull that up. So up there at the top, we'll see in our example, there's a 5% dues increase starting on January 1st and a 5% special assessment due on July 1st, 2026. It's also noted at the bottom in a little bit more detail of that page. It'll spell both of those out for you as well. As a general rule, dues increases are capped at 20% per year, and special assessments are capped at 5%. It is possible to go above these limits with a homeowner vote or in an emergency situation. Dues increases usually reflect inflation and the rising costs of insurance, utilities, and vendor contracts. Special assessments are often a sign that reserves are underfunded. Neither is automatically a bad thing, but both should raise the questions, why is this needed and what is it funding? Next is the expense spending categories. So it is important to review the spending categories in your budget. This helps you understand what your dues actually pay for. So Shauna, if you can pull up just maybe that first page of the budget. There we go. So at the top, you've got your income, the various income line items, and then the expenses. This is the categories that we're talking, the expense categories that we're talking about. This one has insurance, administrative, landscape, all the way down, all the way at the bottom would be reserves. If we look at the budget, you will see the expense categories by detail and in summary. So if you want to know where your money is going, this is where we would look. And then if you look at the bottom of this page, or I'm sorry, the next page, we'll see that at the very bottom, it says total expenses of about 1.2 million, total income of 1.2 million, and a net income of 0. Understanding the various categories here helps you see what drives dues increases and what areas may need future control. Number 4 is there a budget contingency? So your budget may also include a contingency line item, which is an additional line item for the unexpected. In the real world, emergencies happen, prices change, and unexpected repairs occur. It is good to be prepared for these in your budget. Without a contingency, every surprise has the risk of becoming a deficit or a special assessment. We definitely don't want that. In our example, they actually do not have a contingency line item. However, it is possible that they added a cushion into some of these expense line items to make up for that. Next, your budget should match your reserve study's recommended contribution. So if your reserve study says you need $200,000 per year, but your budget only funds $100,000 per year, you are underfunding your reserves. And this could lead to a future special assessment. In the case of our example, so Shauna can go, so the budget here includes over $200,000 in reserve contributions. That's the line item that's highlighted. And over $50,000 in reserve special assessments, showing an effort to align with the reserve recommendations. And if we look at the cover page here of our reserve study, we'll see those numbers. It's actually broken out by month. So it's the line item that says recommended 2026 monthly reserve transfer of 21,500. That comes out to 258,000. So the association got to the 258,000 or just under it by a normal reserve contribution and the special assessment. Normally, we would say you need to do that with a normal reserve contribution and not the special assessment, because this is actually calling for the line item right below where that's highlighted, is actually calling for a special assessment, a large special assessment to help catch this association up. So the alignment of your budget and reserve study is critical for long-term stability of your HOA. Okay, the next line item, go back one page. Oh no, you got it. You're right. Sorry about that. The next one is the 10% rule. So is the reserve allocation at least 10% of the budget? Lenders typically look for at least 10% of the budget going to reserves, and many loan programs require this. In our example, the total budget is roughly 1.2 million. That's down at the bottom. So we would like to see a minimum of $120,000 being allocated to reserves. As you can see, there's over $250,000 in this case, so they are well above that limit. Next is the component list. So your reserve study should include every major common area component. You can review these in the executive summary table of the reserve study. So, there you go. So that's what this page is, and it shows each component. It shows the categories, all the individual components, the useful life, the expected useful lives, the remaining useful lives, and then the current average cost to replace those units. Missing items here means missing money, so it's important that this list be complete. It's also another good thing that associations every 3 years need to have an on-site visit for this reserve study, because it helps as they go and do a walkthrough. It helps identify any missing items. Okay, number 8 on our list is the 0 useful life components. So 0 remaining useful life means the component is already due for replacement. And you can see these back again on the executive summary here. And they're for this reserve study, they're included here in yellow. Every line item that's highlighted in yellow has a 0 useful life. It's important to note that just because a component has no remaining useful life, that doesn't mean that it has to be replaced now. Remember, these are just estimates from the reserve study analyst based on their metrics. That's the board can decide if something actually needs to be replaced or not. It is crucial to look at any component project costs per your reserve study. Components with 0 to 3 useful life remaining will likely need to be replaced soon. Then you must ask yourself, number 9 on our list, does the HOA have the money in the reserve fund to perform those projects? If the answer is yes, then things are right on track. If the answer is no, then the HOA will likely have to rely on a special assessment or a loan at some point. This is one of the biggest warning signs homeowners should watch out for. If a special assessment is needed, that is more money out of your pocket. And our final thing to look for on the reserve is the reserve funding percentage. This again is located back on the reserve study, the executive summary page. And the percent funded compares what you should have saved versus what you actually have saved. In our example here, the very first line in that gray box says projected starting reserve balance, and that's 568,000. So that's how much money they project that they will have as of January 1st, 2026. But the fully funded balance is over 3.4 million. That's why the percent funded, that third line, is only 16.6%. And you can see, according to the bar chart, that this percent funding is considered weak, high risk of special assessment. That's that X in the bar graph right there in red. Below 30% is considered weak. That's the one in red. 30 to 70% is considered fair. That's the yellow. And over 70% is considered strong. That would be green or blue. A low funding percentage, which this HOA has, means higher risk of special assessment and deferred maintenance, something you do not want to have if you can help it. As a final takeaway, your budget and reserve study are your HOA's financial roadmap, both for the current year and for the future. Healthy HOAs plan early, fund reserves consistently, and avoid emergency funding. Struggling HOAs delay projects, rely on special assessments, and shift costs to future owners. When you understand these two reports, you are more empowered as a homeowner and can ask questions to better comprehend the board's decisions. Thank you for your time tonight, and hopefully you now have the tools and knowledge to be a more informed and involved homeowner in your community. Thank you. Well, I guess we should open it up and see if there's some questions.
Yes, definitely want Q&A. I know Matt had a couple of questions that he answered already, but let's see if there was, I think one question was if you guys can get a copy of the presentation, which yes, we will definitely circulate this. We have also recorded this presentation, so we will make sure to send out a link to the presentation. Let's see. What would be the form for owners knowing what makes up the line item amounts? Well, let's go into that since we have a little bit of time. And then Leslie says, Shauna, can you send Matt the copy of the package that we're using in tonight's slide? Okay, and that one can be circulated. All right, so let's go with the budget. And then if we can kind of expand the budget a little bit, so that we can better, there we go. Okay, so this isn't going to be specific to your association, but you should be able to look at yours and get an understanding of how to read it. So at the top, we have the income line items. The biggest one is going to generally be your association's fee income. That is basically, in this case, it was 163 units times whatever their monthly dues are, let's say $400 a month, times 12. So that is their annual budget. So whatever the homeowners are paying for dues is what for the year is what we come up with for that number. In this case, there's parking assessments. So people pay for parking. That's one way the association makes a little bit of extra revenue, and late fee income, and laundry income for this association. And then this one is also planning a 5% special assessment. Then we go into the administrative expenses. So the audit and tax preparation, each association is legally required to hire a third-party company, and this should actually help alleviate or make homeowners feel more comfortable. Even though we as the management company are hired to manage your association's monthly financials, if you have $75,000 or more in annual revenue, which most associations pretty much do, this one has over $1 million, you are required to conduct a review using a third-party accounting firm. That accounting firm is going to be looking at the monthly financials. They're going to be providing a report. It's a standalone year-end financial package. And associations are required to also mail that out to the membership each year. So there's the tax preparations. Because you're a corporation, your association has to file taxes, and then it's hiring a third-party company. So you're going to have to spend money in this category. For board and committee expenses, this can be anything from, board members laminating signs and posting signs for upcoming meetings. It could be supplies for, committee members or board members. It could be, in some instances, some associations rent out meeting spaces. So a variety of things can go into that. Legal expense, depending on complexities, whether or not your association has any active litigation, generally speaking, there are so many laws that govern homeowners associations and so many complex issues that come up that every association has to consult with legal counsel at some point. So again, sometimes more, sometimes less, but most association attorneys who specialize in HOA law can be pretty pricey. You know, they charge $500, $600 an hour. And so that is really what that line item accounts for, is just kind of figuring how much did we spend last year? Do we still have more complex legal issues? Do we have any legal projects on the horizon? Like, are we going to restate our CC&Rs or look at redoing our bylaws or redoing our rules and regulations? Those are all things that would require budgeting for legal expenses. Management fees, those are based off of our monthly management fees. And so that is a set contracted amount. Administrative expenses and office supplies, postage and delivery. Usually that all goes to mailing your checks out, payments to vendors, and of course, mailing documents like this that are required to be mailed by statute to all homeowners, and your monthly billing statements that you all receive. Your reserve study, we're required to do it. That's again another cost that's budgeted for. This association actually has employees, so they have payroll charges. Bank charges are usually pretty nominal. It's usually for any NSF charges. If a homeowner submits a check that bounces or places a stop payment. And then the insurance. I mean, this year, this market has been really brutal in general because of the claims that have come up across the country. Most insurance companies, not just in California, but in every state, have increased their premiums across the board. So we've seen this number jump substantially. We've seen people who've had premiums of 30,000 go to 120,000 a year. So this has been a really tough one to contend with. And if your insurance goes up, just remember that your vendors, their insurance goes up. Everybody's insurance has gone up. So we've been seeing a lot of the vendors' prices go up. Our insurance as a management company has gone up. So that usually means we have to extend that cost or that increase to our clients. Your landscaper's insurance went up. Your janitorial company's insurance went up. So when they have increased costs of operation, they're going to pass that through to their clients as well. So let's keep going down here.
There's a follow-up question that he had, Netta, where they're actually asking if you want to drill into that number, like what's the best forum to do that? Like going to a board meeting and asking what makes up this $2,000 of this example of office expenses.
Gotcha. So that's a good one where you could just ask specifically, can I see the breakdown, that particular general ledger of expenses specific to those, like office expenses, specific to insurance, so you can drill that down and ask for a copy of last year's expenses in any category so that you can understand what your association specifically spent on. Now, I will tell you that sometimes an association may have to redact the information.
Yeah.
So for example, if you're asking for all copies of legal transactions, if anything is executive session or privileged in nature where it can't be publicly shared, so if there's ongoing lawsuits or kind of disputes with homeowners, the association legally can't disclose certain details. So they would still give you the details, but they would have to black out that information. So I just want to make sure that, but most of these things you can ask for and receive. There's nothing privileged about the pool or irrigation repairs or insurance or things like that. It's usually more legal type stuff. Or if you're asking for on the revenue side, I want to see what our revenue looks like. It's like, well, that actually gives you transactions related to specific homeowners and their addresses. And so that would also be privileged that we couldn't, fully disclose or provide that information with detail. So it would just be, this amount came in on this date, but we couldn't tell you which homeowner paid it because that, does risk some privacy concerns, and again, executive session information. Okay, so basically that kind of gives you the gist of it. Like under landscape, the landscape maintenance contract, that's going to be a fixed cost. I will tell you, most borers, when it comes to landscape extras and irrigation repairs, they're really drilling hard on the landscapers to keep those costs at a reasonable level. Many of our boards actually look for new companies if they feel that their landscape providers are being frivolous and charging them too much for extras or different things. The same goes with the pool company. You have your, pool management, which is under 60403. But then, under pool and spa supplies and pool supplies and spa permits, the permits are the permits. You actually need that through the county. But everything else, boards really look at how much we're spending, and whether it was just kind of a one-off, like the pool heater needed a new component, the motherboard died and we needed to replace just that one component. They're looking at that versus replacing the whole pool heater. There's stuff like that that comes up. And then there was a question about the recommended special assessment for reserves. Does the recommended monthly reserve transfer include the special assessment for reserves needed? So sometimes some associations are so far behind that even with a dues increase of 20%, which is the maximum the board can approve without asking the membership for your approval, is not enough to meet the reserve study's recommendations. Sometimes the only way to really get back on track is through a special assessment. And so there's really three strategies that boards have. One strategy is dues increases, which I don't personally love, because once your dues go up, the likelihood of them coming back down is tough. And that 20% increase doesn't really move the needle far enough when you're that far behind, where you're only 16% funded. A 20% dues increase, like if I'm spending $500 a month on dues and I give the association an extra $100, my $100 times 100 homes is only going to be $10,000 a month. When we're talking about missing 3 million, that $10,000 a month isn't really going to move the needle much to make a dent where we need it. So some associations, the other thing that they can do in addition to a 20% dues increase is to also assess homeowners that one-time special assessment of up to 5% of your gross annual expenses. So if your gross annual expenses is $1 million, the association is permitted to assess, is it 50,000? And then spread that up across homeowners. But again, that $50,000, when you're looking at a $3 million deficit, isn't going to really move the needle. So in situations like this, the board really needs to work out a comprehensive plan. What I would suggest in a case like this is to look at the critical items that need replacement, the things that cost a lot. So Shauna, go back up to the budget real quick and show me under like plumbing repairs, interior repairs, stuff like that. Keep going. Okay, under repair and maintenance. So let's see, under general repairs and maintenance, this association is spending $25,000. They're spending $30,000 in remediation, which basically means they have water intrusions and they're spending $30,000 to resolve those water intrusions. Go up, I think we go up. Okay, HVAC. I mean, go down to building expenses. They only put $3,000 there, but I can bet you that they probably spend a lot more than $3,000 a year in building expenses based on what we're looking at. So right now, I mean, they're spending $35,000 in plumbing repairs. They're spending $30,000 in remediation, $25,000 in repairs and maintenance. So, I mean, at this point, we're almost at $100,000 of just Band-Aid fixing. So when you're doing that, again, I guarantee you this association probably spent more in the prior year, but they're trying to budget more conservatively in a favorable way for themselves. But when you're really at a 16% funding and you have all those yellows with stuff that needs to be replaced, what's more typical is that you start to see a lot of leaks and a lot of interior damage. So not only is it costing the association a lot of money, I would rather see the association special assess its homeowners that $100,000 and put it in the reserves, or start to, focus on how to replace some of these things that are causing those damage, the damage, than to just keep bleeding out $100,000+ a year. That's 10% of the budget, essentially, that's bleeding out just to put band-aids on components. So that's really critical about is getting to the root of the issue. And yes, it's a little painful to come up with, like, for example, let's see, what go up. Do we have roofs on this one? I keep going up. Let's see. Okay, so the flat roofs need to be replaced there. It looks like one segment. Okay, the roofs are okay. Keep going. So we need tower surface repaint for 355.
Yeah, if the total here is about 1.3 million of things that have a zero useful life. And that's where they come up with that $750,000 recommended special assessment, because they have about $550,000 in cash. They need about another 750,000 just to take care of the items that are at zero useful life.
Yeah, so it looks like there's a section of flat roofs that need to be replaced. So those are probably causing, some repairs issues there. Do they have plumbing listed on here? Because it looks like their plumbing is probably giving them grief. And some associations don't even have all the components that they need to be listed. Shauna, can you scroll down and let us see if there's any plumbing anywhere here? Parking and garage, electrical fire pump, electrical panels, boiler, hot water. There's some plumbing. They've done it as like a general, like a partial replacement every 5 years. Plumbing and gas line partial replacement, as opposed to like, let's overhaul the whole plumbing system, which at some point every association is going to need to do. So if you look at their budget, they're spending $35,000 a year just to Band-Aid, but then they've only allocated $50,000 every 5 years to partially replace. So that isn't really advisable. We kind of flip that around and add more, or ideally add more. But, in this case, their funding percentage is so low, it's hard to increase that without affecting all the other components that need to be done. So this association with a special assessment, they're basically saying they recommend $21,500 a month to be allocated to the reserves, plus in addition to a $750,000 one-time special assessment that year. So
and that's just as of 2026.
Right. So if the association doesn't do that this year, which they weren't planning on for this in this case, they're going to fall behind again next year. And next year that number is going to be bigger. And next year we're going to be spending more on the plumbing, on the operating budget. So these are things that you really need to look at. And I will say most boards have great intentions, but it's really where homeowners get upset when they need to either pay more in dues or special assess, which is understandable. Nobody wants to spend more money, especially not this year when everything has gone up. I mean, I used to go to the grocery store and buy 2 bags of groceries for $60, and now I buy 1 bag for like $250. I mean, it's become very difficult to just kind of keep up with the increased cost of living. But at some point, we just want to look at things and figure out how to spend wisely, not flush money down the toilet, pun intended, since this association is literally spending $35,000 on plumbing repairs. If we did an overhaul of the plumbing, that line item should be closer to zero, and homeowners would not be displaced and would not be as disrupted. And the interior repairs would be better too. Okay, so there was a question about the line item. Where can I learn? Okay. Derek
There
said,
was a follow-up question to the difference between the recommended reserve monthly transfer. So that's just the 2026 recommendation, the monthly recommended transfer. That's the 21,500. The other line item that you were talking about, the monthly reserve transfer rate, that was the rate at which the association was funding reserves in 2025. So that's the difference.
there was one question here where Derek said that the two documents, the budget and reserve study, can affect home values. Can you flesh that out more? So just to answer that very simply, if you have 16% funding, you're going to have a building that looks like there's deferred maintenance. You're not going to have a building that looks brand new, that is modern. You can know that they're behind on painting. The exterior of the building looks like it's behind on maintenance. The decks haven't been replaced. They need to be replaced. So you're probably seeing some peeling in the deck. So when people walk through the community and see that, they're going to see, a community that looks more dilapidated than pristine. So you're not going to be able to command that. Also, when lenders are looking at this number, they're going to feel like this is a risk. As far as an association, when any association is under 30% funded, lenders get concerned because they know that the risk of a special assessment is high. And when they're lending money to homeowners, they want to make sure that homeowners have the means to pay their mortgage. If an association is turning around and having to hit each homeowner with a $10,000 or $15,000 special assessment, the lender is going to be concerned about that because they're going to worry that there's not enough money for the homeowner to be able to keep up with their mortgage and get this association back up to a point where there is enough money in the reserves. And the same with the budget. So the higher the dues, the higher they're looking at your loan to debt ratio, your lenders. So they're looking at what can you afford to buy. If your mortgage or your mortgage is, let's say, $2,000 a month, but you also have property taxes, insurance, that adds another, let's say, $400 a month. And then you also have dues to the tune of $600 a month. And then you will probably have an assessment, a special assessment based on this information to the tune of $5,000 this year, which comes out to probably another $400 a month. You're going to qualify for less because the dues and potential special assessments are high. So that's in part why I say it's not a great idea to try and catch up to the reserve deficit with a dues increase, because you need to properly budget so that you can keep up with your operating costs. So it's not like I'm not saying this to say make it $200 a month, but then you're not going to have enough money to pay for your insurance and all the other things. Like, you need to have enough to cover all the other things, but doing the one-time special assessment and just like ripping that Band-Aid off and funding your reserves is the challenging way to go, but a better way to go, because the lender is not going to be looking at increases in dues and trying, and this goes not just to new purchases. This is if you ever want to refinance. Some homeowners are like, but I'm paying this already. What do you mean I'm not qualifying for a refinance? And they're like, well, your loan to debt ratio is this much, and so your dues are too high, and we need your monthly debt or potential debt to be under, this much. It's like 35%. So if you have, let's say, income of $10,000 a month, they want to make sure that your loan to debt is going to be about $3,500, that you have $6,500 a month left over to pay for, all your other living expenses. So if your dues and your mortgage and your property taxes and insurance and potential special assessments are going to be higher than that 35%, meaning 3,500 when we're looking at 10,000, they're going to reject you and say, you don't qualify for this. Even though you're going to be paying less to refinance at a lower rate, you're still not qualified. So that affects you as well. So these are things to think about and how it does directly affect your property values and your lending capabilities or opportunities, I should say. So I think we're at the end, we're just a little over, but we had a couple, we're going to launch a poll because we want to hear from you in terms of what you want to our next webinar to be. So help us with this poll. And click on which you would prefer to hear next. We have understanding HOA financials. So this is actually opening up financials, looking at the balance sheet, income statement, profit and loss, so on and so forth, and really having Derek explain that. The HOA governing documents, we pull up some CC&Rs and we go through that. And we go through bylaws and we really kind of navigate where you can find what. Homeowners' rights and responsibilities, especially maintenance responsibilities. What is the owner responsible for versus the HOA? Violations enforcement, we explain that. The difference between a board meeting versus a membership meeting. What to expect at a board meeting, you know, going through the format of a board meeting. And, well, we kind of talked about homeowner rights and responsibilities, which I think we probably cover the HOA versus homeowner responsibility a little bit on C, but G would HOA versus homeowner responsibility, we specifically focus on that. So, and then we have H, insurance basics, where perhaps we can invite an insurance agent who specializes in HOAs to go over insurance policies and explain that. And legal Q&A, ask an HOA attorney. So we invite you to submit your questions ahead of time, and then we'd have an HOA attorney here to run through those questions and answer those. So let's leave this open for another 15 or so seconds so that we can capture this. Homeowner rights and responsibilities, that's a good one. That seems like that's the next one, but we'll take violations and enforcement explained, I think, is number 2 so far. All right. Anybody else who wants to participate? Let's go 5, 4, 3, 2, and 1. We're going to end the poll. Thank you for participating. Let's share the results. And nobody really wanted to know financials. I guess we covered it tonight, Derek. We did a good job.
I get off the hook. I'm off the hook. That's good.
Off the hook for the next one. But we did have the homeowner rights and responsibilities, like I said, to that kind of 30% of folks here wanted to hear. So, all right, we will work on putting that together. We'll probably put another webinar on in the next 2 to 3 months. So stay tuned for the date on the next webinar and the details. And again, we thank you for joining us tonight. And thank you for your thoughtful questions. And for being here and wanting to learn more and being a more involved homeowner. It's really empowerment through education. So the more we can help you understand these things, the better you will be able to navigate your day-to-day, and you'll be able to collaborate with your board on these types of topics. So again, thanks for coming, and we hope to see you again very soon. Have a wonderful evening, and if you haven't already, enjoy dinner. Thanks, guys.
Bye, everyone. Thank you.